Hi, my name is Eric Early. I'm an attorney here in Las Vegas, and the problem is you're trying to decide between short sale and loan modification. Let's get right into this. Application process, the same. We don't need to go there. It's the same headache either way. Next thing, remaining balance. Yeah, this might come as a surprise to you, but you're going to owe more with loan modification. A lot of people come to me and they say, why? Why is this more? I got my permanent mod today and I owe more than I did when I began. Here's why, just so you understand and you can figure out whether it's worth it. During the trial payment period, which is usually 3 months, the difference between what you were paying and the trial period payment, that difference, that savings, is actually stuck on the back of your loan. Now, this only happens during the trial period payment portion. But that payment is going to get stuck on the back of your loan. So your loan's going to get bigger. And this is why some banks actually stretch out that trial period plan. They stretch it from 3 months, which is what it typically is, to 1.5 years. Now that is dirty. That's just rotten. But they're doing it to get more money. And I just want to warn you about it. That is one of the techniques that some banks use to get more money. But your payment will be lower, but the principal is going to be bigger every single time. Just kind of keep that in mind. Now let's compare. Over here, the remaining balance on a short sale, typically 0. Why? Because we settled out the debt. We sold the property. Now, usually there's a deficiency balance. Usually it's a huge deficiency balance. And in Nevada, they have a right to sue you for that balance. But if you hire the right negotiator, we typically get that negotiated away completely. They put it in writing. We waive the deficiency balance. We waive our right to sue, etc. That is the beauty of the short sale, is you can get out of the debt and be free of it. Now, they might ask for a cash contribution. Now, this is something that depends on how much you actually make. Not how much you owe, but how much do you make in a year. Because if you're making 6 figures, they're probably going to ask for something. We have a lot of clients that they don't ask anything for, that are making good money. But 6 figures, they might ask for $5,000, $10,000, even $20,000 to settle the debt, to settle that remaining balance. In other words, they won't give you the waiver unless you pay them something extra. And rightfully so. I mean, they could sue you and garnish your wages into infinity. I mean, they have that right. And if you're earning good money, you can't file bankruptcy. So, or at least you can't file a Chapter 7. So there are reasons why they're asking for additional settlement money, but we typically get it settled for less. Even the aggressive banks, most of them are settling it for 20% of the remaining balance, which is huge. That's a huge benefit for you if you're earning really good money and you can get out for 20 cents on the dollar. That's awesome. But for those of you who are earning 50 grand or less, yeah, you shouldn't be paying anything. There shouldn't be a promissory note. Why? Because we get to threaten them with bankruptcy. You could qualify for a Chapter 7. And so we don't like going down that route, but we'll threaten it day and night. And so that's usually something as part of our negotiating arsenal, we're able to bring into play and get this balance down. But in the end, typically, you don't owe anything. That's the beauty. You settle it out for a few grand and you're done. Where over here you owe lots. Now let's talk credit. If you want to buy again, if you're looking at buying again 5 or 7 or 10 years from now, this is not the way to go. Not if you're typical in Las Vegas. You're upside down 40, 50, 60%. If it's a condo, you might be upside down 75%. So this is insanely crazy if that's your situation. Now, if you're only 20% upside down, maybe this works because you could get out and sell again in 5 years. Your equity might have returned because, remember, normal appreciation, 2 to 3% annually. So you can see why it's going to take you 15 to 20 years or longer to recoup your value in that property and actually be able to sell it. Now, one thing over here, 2 years. We're typically seeing people being able to buy again 2 years. Their credit's recovered. They've got good FICO scores coming back. One of our clients had two loans that he defaulted on. We did the short sale, 6 months worth of non-payments during that time period. His FICO score 6 months after the short sale, 721. Now, he had an 800 FICO score before. He made all his other payments perfectly, just the 2 loans that he didn't pay on. But yeah, 6 months afterwards, 721, that's a good score. I don't care whose book you're in. That's a good score. You could buy usually with that. But there are other reasons why you might have to wait 2 years after a short sale to actually purchase again. So, but 2 years versus 20 years, big difference here. And you can take advantage of the down market. So you might really be well off here. Another thing to keep in mind, the tax exemption on the debt forgiveness, that's right. IRS considers that to be income. Anytime a bank forgives money, that's income, taxable at ordinary rates. But January 1st, 2013 is when it expires. That's the primary residence exemption. If you're trying to get out of the tax based on that exemption, you better act quickly because you only have another little over a year left. But there are other ways of getting you out of this tax, so don't let this talk you out of it. There's the insolvency exception. I have a whole thing that I did, another presentation just on tax consequences. You should look that up. But everything here is geared toward freedom, getting out of the debt. Even some banks will give you cash incentives to help you participate with the program and help you with your moving expenses. So this is a way out, and it's a very effective way out, a way to preserve your credit, and a way to move on with your life. This way is a long-term commitment. You're looking, again, if you're in Las Vegas, maybe 20 to life. Sounds like a prison sentence almost. But what kind of needs are you going to have in a house 10 years from now? Because you still might need another 10 after that before you can get out of this and get away from this property. Some of the techniques that they use don't really make a whole lot of sense to me. I mean, I understand why they're doing it. Lowering your interest rate down to 2 years, that's the first thing that they do. But they're only aiming at this 31%. That's 31% of your gross income. That's what's affordable. That's what they consider affordable. They're not going to lower your payment down below this. So if you think that, oh golly, I can get this 2% interest for 5 years, but you're already at the 31%, or maybe you're at 32% of your gross income, they're not going to do it. It's a waste of time. It's only going to lower your payment $50, and they're not going to do it. It's got to make a difference. So are they going to stretch it out to 40 years if they only have to lower it a little bit? No, they're not even going to get to this other stuff. So you're looking at 2% as the maximum that they're going to lower it if they need to get you to the 31%. So don't even be considering this if you're below already, your payment is less than 31% of your gross income. It's just not an option. They're not going to do anything with you. So you got to keep in mind the way this works. But this is crazy stuff. Stretching your loan out to 40 years, that doesn't make a big difference in lowering your payment. It doesn't make a big difference. Talk to a loan officer. But it makes a huge difference to the bank because they make a lot more money. I mean, if I were advising an ordinary person under ordinary circumstances, would you do the 40-year loan or would you do the 30? I wouldn't. I'd say do the 20. This is crazy, the amount of money you're giving the bank. If you can afford it, you would want to cut those years down because the amount of interest is incredible. So they're trapping you in for a long-term commitment where they can take advantage of you. If they've got to do this to you, you really probably ought to bail out of this property. Do the short sale. But these are some of the techniques that they use. They'll defer some of the principal interest-free. They won't forgive the principal. Give up on that. They're not going to do it. But they might defer some of it interest-free out to the year 2050, make it a balloon payment out there. Well, let me tell you something. If you're elderly, I get this a lot from my older clients. If you're elderly and you're thinking, yeah, but I'm attached to this home. I understand sentimental value can mean something, and it's hard to put a price tag on it. But the financial impact that this is going to have on your estate can be devastating. If you plan on leaving anything to your family, just remember, this creditor gets first dibs on your estate. So if you're upside down by $250,000, just think about what that's going to mean. You might be better off moving on and doing this because we could probably get you out fairly cheap. And this creditor is going to suck up your entire estate. That's the scary thing. Sentimental value, is it worth that much? or your kid's worth more? I think that's the issue. This is generally a bad decision here in Las Vegas. Again, unless you're only upside down 20%, I wouldn't recommend it. In fact, even if you are upside down less than 20%, I'd probably still recommend this because it offers freedom. Start over, start new, buy the house, take advantage of the low market that you're in right now. You'll get an affordable rate over here for rent. You don't have to rely on this. You'll probably get a better deal over here in the current market. So think about it. Give me a call, 702-727-8384. I'd love to discuss these issues with you further. Thank you.